Stop scrolling right now. This video can help you save thousands of dollars. What's the smarter move? Earning 10% on a stock or paying off an 8% credit card? Most people would say earning 10%, and they're wrong. By the end of this video, I'll prove to you why paying off that card is like a guaranteed 16% investment, and you'll finally understand the difference between good debt and bad debt forever. Hi, I'm Zeev Friedman, CPA student, and this is Tax Tips Canada. Let's get one thing straight. The CRA only lets you deduct interest from loans that were used for an income-producing purpose. A car loan, your mortgage, or a vacation, that's personal, and the interest is non-deductible. Let's use a clear example. You use a $1,000 line of credit to pay for your vacation. The interest is 8%, which costs you $80 per year in after-tax dollars. Therefore, paying off that $1,000 debt is financially the exact same as buying an investment that guarantees you an 8% after-tax return. Think about it. To earn $80 after tax from an investment, how much would you have had to make before the tax? If your marginal tax rate is, say, 50%, you would need to find a 16% pre-tax investment to equal the $80 you get after tax. Can you find a guaranteed 16% return on the stock market? No, but you can get that exact same financial benefit for paying off your 8% credit card. This is why paying off your personal debt is often the single best investment you can make. So paying off bad debt is our first priority. But what about good debt? Good debt is leverage. It's borrowing money to make more money. But debt is an amplifier. It makes the good times better and the bad times worse. Let's break down some scenarios. For the upside scenario, let's say you invest $1,000 of your own money at 5%. You make $50. Good. Now the upside scenario with debt. You invest $1,000 of your money, but you also borrow $500 at 4%. Your total investment is $1,500. You earn 5% on $1,500, which is $75. You pay 4% on $500, which is $20. Your net profit is $55. You made money using debt. That's good leverage. But what about the downside scenario? What if the investment returns 3%? With no debt, you invest $1,000 at 3%, you make $30. With debt, you invest $1,500 at 3%, which is $45. You still pay $20 in interest. Your net profit is only $25. You made less money. The takeaway is good debt is only good if your after-tax return on investment is higher than your after-tax cost of the interest. And since interest on investment loans is deductible, that spread can be very powerful. Okay, we've covered bad debt and good debt. But what if you could turn bad debt into good debt? You can, and it's 100% legal. It's an advanced tax strategy exhibited in the Supreme Court case called Singleton versus the Queen. Here, the court decided that interest deductibility depends on the direct use of borrowed funds, not the economic substance of the transaction or your overall reason for doing it. Here's how to apply it. First, the wrong way. You have $100,000 in stocks and you need $100,000 for a down payment. You borrow $100,000 for the house and keep your stocks. That loan is for personal use, so the interest is not deductible. Now, the right way. First, you sell your $100,000 in stocks and use that cash for the house down payment. Second, you then borrow $100,000 and use it immediately to rebuy your investments. What's the result? You're in the exact same financial position, but because of the direct use, that $100,000 loan was to buy investments, an income-producing purpose. That interest on the loan is now tax deductible. You've legally swapped non-deductible debt for deductible debt. Now that's effective tax planning. Let's recap. First, bad debt is a killer. Paying off an 8% credit card is like getting a 16% guaranteed pre-tax return. Second, good debt is like an amplifier. It can boost your returns, but it can also magnify your losses. And third, you can strategize. With proper planning, you can structure your affairs, like the Singleton case, to make your interest tax deductible. This is not financial advice, but it is proof that you should plan your taxes, not just pay them. If this helped you rethink your debt, Drop a like and follow the channel with notifications on so you never miss a future video. And if you're looking for an accountant, comment the word accountant down below. All right, and now the moment you've all been waiting for. The winner of the $20 Amazon gift card announced in last video for commenting "keeping more of what I earn" is... Congratulations, make sure you check your inbox to get your prize. Thank you for watching. See you next Tuesday on Tax Tips Canada. And remember, it's not what you earn, it's what you keep.